just coming in, this is going to be the weekly Howl. It's a series every Friday at 5 p.m. EST, so the market will always be pretty much closed by it, that I'm going to be doing with a number of your favorite creators and people that you like to talk to on the internet about what stocks are trading. So I figured it'd be fun to get them all in a room and just chat about what they traded this week. So we're going to honestly just kick it right off. So we're going to start with a little bit of an interesting side of some trades. So Decade, I think you have, the cool thing here is that we have so many different approaches to trading. So I feel like we're going to hear some unique things. But Decade, I want you to have a chance to kind of lead this off. What trades did you make this week? What did you buy? Did you sell anything? If so, why did you sell? And what are you looking for in this coming week?
Yeah, so first off, I think what you guys are putting together here, this weekly Howl, is going to be awesome. Some big heavy hitters in here every week just chatting about the market and their thoughts. So if you're listening in on this, I'll be checking in every week. Hopefully, I'll be speaking in the future, but if not, I'll still be checking in because this is going to be some cool stuff that you guys are putting together. But this past week, shortened week, we didn't have the markets open today. So a lot of people today, like me, were kind of like, what do we do on a Friday with no market? But so I'm actually up on my account right now, just kind of going back. So on Monday, I bought some more QQQJ. If you follow me or if you're on here, I always, that's my pick in the bracket as well. So I bought some more QQJ. I also bought some more VOO, which is the S&P 500 ETF. I do mostly ETF investing, index fund investing. I do have a smaller individual portfolio. Is mainly what I talk about when I do my end of the day, top three, bottom three, winners and losers for the day. But I put $500 in there, and I use M1 Finance, which kind of just breaks it up for me automatically. I set what percentages I want, and they have those big name stocks that I just kind of want to put a little bit of money into and just see how they do. So Waste Management, Apple, Microsoft, Visa. I also had to do a old 401k rollover into an IRA. So I took that and I put that also in QQJ. Those were my buys for the week. I did sell on Monday, or actually Friday of last week, but I'm sure it's okay if we talk about it. But I sold. I had a little bit of money in QQQM, which is the same as QQQ. It's just it's a less frequently traded ETF and a slightly lower expense ratio. But other than that, it's the same breakdown. But I sold out of that just because I have the S&P 500 VOO, and so I didn't really see the need to have the two. So I just put that into QQJ. Again, I'm younger, so I'm a little bit more risk in that sense. I guess if you can really be risky in an ETF, but that's kind of what I did with this week, though, was buying into that QQJ. I'm really focused on right now just building up that position. I think it's really, it's a new ETF, but I think it's still really undervalued for the holdings it has, as well as just the future of the NASDAQ is what it holds. Stocks 101 to 200, largest on the NASDAQ. So I think it's still really undervalued. So I'm swallowing up, even though this past week, Wednesday, Thursday, it kind of jumped up a little bit into upper 30s, or excuse me, upper 31s, 32. Let me see what it closed at yesterday. Closed at 32.37. So, I bought in trying to get my average price down earlier in the week and last week, but I still think, to be honest, this is my opinion, but I think under $50 in this ETF for the future of it is really a good swallow. So I'm really just kind of building up this position in QQJ right now, and in the bracket in the bracket is doing really well today. The voting opened up for it. So if you're in here and you want to vote QQJ over VTI, go down there, and we're holding strong. But all the votes that count we can take. But that was kind of my buys and sells for the week. I don't do really individuals, so a lot of it's just buying into ETFs or selling them. I usually don't sell. I just sold off that QQQM just to put into QQJ just to see, might as well. So that's kind of what I did for the week. Nothing too special. I don't have, any stocks in particular, but mainly just right now focused on QQQJ.
Love that. Yeah, a nice approach to this week. And one of the things I did want to touch on real quick for the listeners, because you mentioned it, was you rolled over a. Did you say you rolled over an IRA?
I rolled over an old 401k
Okay.
into an IRA.
Maybe it would
Yep.
be helpful to just give like 30 seconds on how you did that for people that might need to do that.
Yeah. So it's really, really easy. Um, what I did, so I rolled it from Charles Schwab into Fidelity. So I went to my account already had Infidelity. I just went to open up a new rollover IRA, and you just fill out. I mean, it lays it out, like just like a piece of paper. It just says, where are you transferring it from. Sometimes you may have to. In my case, I had to go back to Charles Schwab and let them know. But sometimes you don't have to. But it's really easy. Depending on where you're going and where you're coming from, like with the brokerage types, it's usually sometimes a matter of just a week. I mean, I filled out the information last, I think it was Monday or Tuesday, and it was in my Fidelity account by Tuesday of this week. So less than a week. Just really easy. I mean, just fill out the information and then boom, roll it over, and now you save that taxable bill because you're rolling over from a 401k, traditional 401k into a traditional IRA.
Love that. Yeah, that's a great explanation. And for more on that 401ks and IRAs, I'm actually going to be hosting another, not a series, but probably a space that's going to focus on financial literacy with Hero Dividend and several others. So that'll be upcoming. But we just heard from Decade Investor for everyone that's joined. He was talking about his buys and sells this week. He's very ETF focused, a lot of QQQJ, sold a bit of QQQM, but just to, was it a different one? I think it was QQM, just to move
Yeah, that's
over.
right.
And just to hit on it, because he mentioned it, if you haven't voted yet, there are Market Madness polls that are live right now on my page. They're my pinned tweet. Just to run through that real quick, GameStop is going versus Ozone. Ozone has a 51.1% of that vote, so barely in the lead. Jonah, who I'm going to go to right after this, backed DMTK this morning, who is crushing the hell out of Penn with 84% of that vote, over 1,000 votes counted. AbbVie is beating Boeing with 55.5% of that vote. Buzz and SPCE are very close. SPCE slightly leads the Buzz Social Sentiment ETF. And then Decade Investor's own QQQJ has almost 70% of the vote versus VTI. That could be a bit of an upset. We'll see what happens there. All right, now we just heard Decade Investor with his very ETF heavy approach. So to kind of juxtapose that, I'm throwing over to Jonah. Jonah, what were your buys and sells like this week? What was your mindset, and what are you looking at next week?
So I didn't do a lot of selling this week. Most of my selling was the last 2 weeks. A lot of people know that I'm pretty heavy into growth stocks. They took a beating the first 2 weeks of March. So, I did some selling a couple weeks back, got out of some of the more aggressive names, some of the SPACs. You could just say my lower conviction names, or at least the stocks that I thought might struggle over the next couple months, and decided to use that cash from those sales to double down on the top half of my portfolio, which are obviously my higher conviction names. In some cases, had either reported earnings already and had put up some really, really strong numbers, but the market hadn't really given them any appreciation for those numbers. And I felt like it was just a matter of time before the market did, or when we finally found a bottom in this little pullback and the stock started to bounce, it would be, I believed it would be the stocks that had already shown the strongest fundamentals that would bounce the hardest. So, a lot of the selling that I did a couple of weeks back, that cash went into Futu, Upstart, Dermtech, Transmedics, what else? Cellulus, ClearPoint, Audio Eye, really the top 6 to 8, maybe 10 names in my portfolio. And then Upstart went up 3x. Futu is up. So this is kind of how I manage money. So Upstart was probably a 9% position, 8 or 9% position going into their earnings a couple weeks ago. The stock was up 3x in 3 days. I've never had a top position do that before. So I sold about a third of my position between 140 and 165, and then spread that cash around the portfolio, but put the overwhelming amount of that cash into Futu as Futu pulled back to 100 either late last week or early this week. And then Futu ripped 50% this week, 50% on Monday, Tuesday, and Wednesday. So on Wednesday, I started trimming Futu and then kind of spread that money back to Upstart after it pulled back and then to my other stock. So, I mean, that's really how I manage money right now. I think, I kind of fucked up. For me to keep coming up with these ideas. And I felt like rather than just, keeping my portfolio where it was, I sort of felt pressure to keep coming up with new names. And I was just adding too many names too quickly to my portfolio. I had way too many names in there, and that's really just not where I'm comfortable. So, going forward, my strategy is I'm going to kind of revert back to what worked for me last year, which is a little bit more concentrated, 15 to 25 of my highest conviction names. And then I can trade around those names because I have a better feeling for how they trade on a daily, weekly basis. I can keep track of 15 or 20 names a lot easier than 40 or 50 names, and I can trim them when they get overextended, and I can buy them back when they either get oversold or pull back to some moving averages. So that's how I'm going to be managing money moving forward. So my big selling was the last 2 weeks. This week, I don't think there was really any selling other than just a little bit of trimming to Futu, and then reallocating that cash across my portfolio. So, I'll be a little bit more picky about when I add new names to my portfolio. Trying to think any recent ads. I did add a company called Intrusion on, I guess that was yesterday. Ticker symbol is INTX. It's a small cap cybersecurity company that used to do a lot of DoD business, and now they're really pivoting into enterprise. So that one's interesting. It's going to be a small position because it's a small company, high risk, but I've been looking for a small cap cybersecurity company for a while. I took a stab at a company called Rapid7, but it's just really not growing fast enough for me. It looks like this one, Intrusion, could have some pretty serious growth over the next couple of years.
Very interesting. And for those that want to look more into Jonah's positions, you can go and it's always his pinned tweet on his profile where he has that Google sheet. Jonah, you said you want to continue to trim down your positions. For those who are listening, how many positions do you have currently right now, or how many are you looking to trim down to?
No, so I'm not looking at my portfolio right now. If I had to guess, I think I'm around 16 or 17 names, maybe 18, including the ad yesterday of Intrusion. I think that's a good number for me. A lot of this just depends on where my stocks go over the next couple weeks, couple months. If Upstart, and I forget where Upstart closed yesterday, let's just call it 150. If Upstart rallied up to 200 next week, I would definitely have to trim it back because it would once again just become too big of a position in my portfolio. Futu pulled back yesterday after being up like 14% on Wednesday, which is when I did a little bit of trimming. And then I actually added to Futu yesterday when it was down like 7 or 8% mid-morning. But if Futu rallied to 200 in the next week or so, I'd have to trim that back. So, trimming at this point is really only going to happen when a stock either goes on a really big 2-3 day run, or a 2 week run, just keeps grinding higher for a couple of weeks to the point where it's just really extended and too far off that 10-day moving average. That's when I would trim it back. I'm trying to keep my positions under 15%, but I'll let them run above 15% if I'm still bullish in the near term. But if I feel like we're going to get a little bit of a pullback, I'll be a little bit more aggressive on the trimming back. I don't see myself getting back to 40 stocks anytime soon. So I think for me, the sweet spot's going to be somewhere between 15 and 25.
Well, I like that. And is there a percentage that you try not to let any certain holding go higher than?
So this is where I've been going back and forth on this. I'm not in the process of launching an ETF yet. I'm still doing some research on it. I'm talking to some providers, vendors, investors, big RAAs that want to put some money in. If you run an ETF and you're going to be bringing in, let's just say $50 million a month, you can't have a really concentrated portfolio of 15 names, especially when you're dealing with, small caps and maybe even some micro caps. So, my theory behind having 40 to 50 stocks in there was to show people that I could outperform with a larger diversified portfolio. But I just think right now in my personal account, it doesn't make sense to do that approach. If I do end up launching an ETF and I have to have more names in there, then so be it. But it's just that's not the right strategy for me right now. Because if I was running an ETF and I did have to have 40 or 50 names in there, I would also have a 3, 4, 5 person team to help me manage the portfolio and keep an eye on that many more stocks. But right now, being a one-person team, 15 to 25 is really all I should be trying to handle.
Agreed. And last thing on that, and then I'm going to go to Chris, and then I might come back with some questions. But you've talked a couple times now about the ETF that you may be creating. Can you talk to us about what would be inside that ETF?
I mean, it would basically be the same strategy that I'm running right now. I mean, it'd be a small cap, mid cap growth strategy, stocks under 10 billion. These high growth disruptive companies that I already own in my portfolio that most people know that I'm already bullish on. Dermtech, Upstart, those types of companies. But I think there's a lot of people that maybe got into investing last year and maybe they did well, maybe they didn't. But I think now that we've run into some volatility and some pullbacks, I think people are realizing that investing is a little bit harder than they realized. And, we all benefited last year from some pretty from some nice tailwinds of, monetary and fiscal policy, but we're not going to get that every year. So if you're going to be managing your portfolio and diving into these high growth names, you better know what you're doing. You better know how to do fundamental research. You better know how to read the charts. And you better have conviction, because I've seen too many people, bail out of growth stocks in the last few weeks as they were going lower. And now that we got it, it looks like we're getting a little bit of a bounce, they're no longer in those stocks to benefit from them. So, investing's hard. You have to have, you can't have weak hands, as they say. And I think a lot of new investors are realizing that they're just not cut out for it. So if there's someone out there that they really believe in, and they're better off giving their money to that person, and then they can go spend that extra 15 hours a week doing something that they actually enjoy or something that they're good at.
Definitely, right. It seems like for a lot of people this past year, they looked at it and it was that easy money, right? They were getting in, and Robinhood was saying, get your free stock right off the bat. But in the long term, as you have said, people cannot have, they have to have a specific mindset when it comes to investing, especially if they're trying to do it for a long-term horizon. They're not a day trader. They're not using algorithmic trading. They're just trying to pick good stocks. In that case, you have to be willing to go from the top and also when it bottoms out. Now, real quick before I get to Chris, this seems like a great time to mention a few things. So first off, our sponsors are Seeking Alpha, TradingView, Finimize, and Sentimentropy. I say sponsors because yes, Wolf Financial is a company. My name is Gav Blacksberg, and I'm the COO of Wolf Financial, as well as the host of Market Madness. I'm going to be hosting a series of spaces. Shout out Twitter for making me a beta host. This weekly Howl is going to happen every Friday at 5 p.m. EST. All of your favorite creators will be on here. So make sure to go and give me a follow so that you can come and listen into them, because they're going to be dropping a ton of insight, whether it's ETF, specific stock picking, growth, value. You're going to get it from every which number of areas. Also, as a lot of you know, I've been running the Market Madness tournament. Market Madness was essentially March Madness for stocks, where you were able to go ahead and fill out this bracket of stocks, ETFs, and cryptos to come down to one winner. And I've been running polls because the whole thing is done on Twitter. I'm very excited to announce right now that we are launching second chance brackets. So if you didn't have a chance to fill out a bracket, I'm literally making the post right now. I just tweeted it out on my page, so go ahead and check my page. Seeking Alpha, TradingView, Finimize, and Sentimentropy. That's socialsentiment.io. You can win premium accounts to all of them. That TradingView one's valued at $600 a year. These are 12-month plans, and all you have to do is fill out a free bracket, and it's starting from Sweet 16. So all the winners are already on the page. They're already picked. Just go ahead. You could do it on mobile. You could do it on desktop, and you can pick either one. But enough with the promos. I'm very excited to hear from Chris about, Chris, what you bought this week, what you sold this week, and what you're looking at for the coming week.
Sure. So, high level, I got out of really all of the SaaS names back in, it was either late January or early February, when the market went into a correction based off of the canceling methodology. And so I was in 100% cash at some point. I think it was early February. I kind of wanted to transition my portfolio over heading into the year because of the massive run that all of the SaaS names had. And just mathematically, right, when you have a big run, say 200 or 300%, et cetera, like a lot of these names had, it just mathematically brings down forward returns. And I'm targeting 25 or 30% CAGR. So it just, from a simple math perspective, it was really hard to get that out of any of these guys after the years they had. Not saying, I mean, a lot of them are great, high quality companies. There are certain prices at which I would want to buy them again. Pinterest actually will be, I'll talk about that because I did buy back into Pinterest, I think yesterday. But for the majority of those names, the forward returns just mathematically came down. So in taking a higher look at back in January when I was preparing for the year of where the trends are, I had some exposure to semiconductors when I first started investing, and I've been adding ever since, but really had a superficial understanding of that landscape. But in looking at the global economy and the market, semi started really popping out at me as a good opportunity. So I started diving in, and the more I dove in, the more that I started realizing and recognizing a really, a really big opportunity here for this market. So starting off with the high level thesis, right? You have, and we'll leave COVID out of this. You have a oncoming demand shock. I think like nothing we've ever seen, which really started kind of with the work from home paradigm and the increased demand for consumer electronics. And then moving forward, everyone talks about 5G and IoT and artificial intelligence, but I don't think many people really understand, if you extrapolate that out and connect the dots, how much of an impact that has on the semiconductor market, not only on the logic side, but also on the memory side, because you need somewhere to store all the algorithms. So with the oncoming demand the way it was, that's a very favorable demand picture. On the supply side, and this just takes diving into, but when it comes to geometry scaling and transistor densities, the industry is really coming up against an issue just from a physics perspective. It can't fit more transistors on a chip. You can just refer back to Moore's law as kind of the high level thought there. So you have, a demand shock and a supply shock to the downside. So you have somewhat of it looks like an ongoing supply and demand imbalance moving forward. So with that, I've really been heavily positioned in semis for the past, like month and a half or so. So bringing that forward to this past week, what I added to, I'm looking here. All right, so I added to Applied Materials on, that was Tuesday or Wednesday, whatever day it was that they had gotten their upgrade from Bernstein. I had about 25% left to finish building out my position. And so I did that on, I believe it was Wednesday. They have an analyst day coming up on Monday or Tuesday, one of those days, the 6th. And, Applied Materials is the number one wafer fab equipment company in the world. And so the high level thesis there is that with supply and demand imbalances, you have chip shortages, throughout the market. So there aren't enough chips currently being produced. And so the thought there was that, well, the fabs and the IDMs are going to have to expand capacity. When you expand capacity, that is all CapEx from those fabs and IDMs. CapEx is wafer fab equipment, WFE revenue. So it's actually interesting that it's all that thesis is playing out really nicely. It started with TSMC, Taiwan Semi, blowing out guidance for 2021 CapEx on their latest earnings call. The estimate was coming at like 21 million, and they are guiding to like 28 million. And then it was a couple days ago, 2 days ago, or yesterday, whatever it was, where they actually announced they plan on spending $100 billion in CapEx over the next 3 years. So a lot of that is going to be going to Applied Materials and Lam Research, which I didn't add to, but I have a meaningful position to. And so that thesis is playing out. I'm comfortable having a full position there, both in my active account and my long-term account. And then going to, and that doesn't even include the $20 billion that Intel committed to when they announced IDM 2.0. I think it was like last week. So that was Applied Materials, and the reason why I got in there. or added to there, finished that out. The next one was, all right, so MKS Instruments. That was, it started off as somewhat of a M&A arbitrage play, where they had backed out of acquiring a company which was getting bid up. So that was accretive to the overall portfolio. Coupled that with the fact that they were selling at really a valuation that was below some of their competitors, with fundamentals actually better than competitors, in my view. And then you couple that with a double bottom chart and that they were breaking out of. And so I built up a pretty meaningful position there. That's going to be a shorter term investment, though. I'm going to see how it acts, look at it around. If it gets up to 20% gain, I'll look at it there and maybe get out of it. But that was more of a M&A, like arbitrage type play. The next one, so I started positions in my active account for KLA 10 Core and Corvo yesterday. Both of them I have been watching and waiting on, and they finally started breaking out. KLA 10 Core is really the leader in process control equipment in the market. Actually, the overwhelming leader. I think they have over 60% market share, something crazy like that. And then Corvo it's similar to, if you think about Qualcomm, they are a big player in kind of the trend of mobile, which ties back to the 5G trend I've been talking about. And so I was waiting for both of those. They finally did break out yesterday, so that's when I started my position there. And if people don't know, I have a process where I basically go through 80% fundamentals, and then the remaining 20% is all based off technicals in terms of when I'm going to buy. And then let me think what else. I made one. It's funny because my long-term account, I only made one trade this week, which was adding to TSM, which was on Wednesday when they didn't break out, but they basically had a 3 inside and up daily chart pattern. And I thought they sold off way too much, just given the sentiment around Intel. The Intel news, for some reason, really knocked down the stock, but people don't understand and realize that two things, really. One is that for Intel to actually make this plan work, for them to turn around the company, become a dominant player again, let's just talk about their third-party foundry space, which they've already failed at doing before. It's going to require not only an intense amount of execution, but also it's going to require a lot of market patience, because it's going to take at least 3 years before you see any sort of impact from these moves that are being made today. So I thought that the reaction was just way too negative on TSM, and my conviction on that name will not probably ever waver. So I added to it on Wednesday, and it just so happened, and this is a good example of how much luck can play into investing. Just so happened that they announced after hours the $100 billion CapEx plan. So I just got lucky there, somewhat lucky, I guess. Some of it was skill, since I was aware of the sell-off, the overwarranted sell-off, and then the chart breakout there. Lastly, my last trade for the week, and I'll stop rambling about semis. I sent out a quick little report on this company called Kulik & Sofa last Friday. I've been working on a longer form report all week. Kulik & Sofa is an advanced packaging play. So I'm sure some of you have heard me ramble on about this topic before, but really quickly, I mentioned earlier on that the industry is having a very difficult time scaling transistors and keeping up with Moore's law. And if you look at the charts, it actually is tapering off in terms of actual transistor density counts, but overall performance is continuing to kind of hit that doubling, if you will, which is going to be performance per watt every 18 months to 2 years. The main reason for that is I guess you could say twofold. One is increasing core counts, which is just basically you have more essentially CPUs on a single package, and the other is advanced packaging, the advanced packaging trend. Whereas historically, packaging was just a way to protect the chips and provide basic connectivity, but what it's become now is the industry now needs to utilize the packaging itself to do a few things. One is to have smaller form factors so that you can fit these chips into all these consumer electronic devices that are shrinking. Second, better power management or better power efficiency so they don't overheat, especially as clock speeds start ticking up. And then lastly, it is just a way to improve overall functionality. So the trend that we're moving towards are chiplets or 2.5D and 3D packaging, which is essentially it's a system on a package, but a little bit more simple than that, right? It's you're fitting it onto a single wafer. So you have all these different types of chips that are brought into one central location, right? So you have shorter interconnections, which makes the whole chip faster, and you have kind of better just working system there. So Kulicke & Soffa they really specialize in wire bonding, which is about 80% of the total packaging and bonding market, and they're the leader there in all the advanced packaging formats, whether it be flip chip or wire bonding. And really the big catalyst for them was their last earnings, where they just blew out earnings. They grew, I think it was 84% top line year over year, and their guidance was simply staggering. They have a backlog throughout all of 2021, and that could persist through 2022. So they're just going to keep building up more and more demand. And then I did a couple different field calls and talked to some of their customers, and specifically ASE, which is the largest OSAT in the world. They were talking about they have a current wire bonding shortage, even though they're at 90% capacity utilization, and that's going to persist through 2022. I could go on and on about the KLIC, which is KLIC, Kulicke & Soffa, that thesis, but KLIC, I now have a full position, and that's a name that it is a little bit risky, a little bit higher of a beta, but that is a name that I am very bullish on, especially for the next year to year and a half, as it's expected that the chip market is supposed to be in a supply and demand imbalance through at least mid 2022. Then on top of the fact that you just have increasing complexity of these chips, which is going to require more and more advanced packaging, which is a higher margin business, and they've finally reached scale at over $1 billion run rate revenue. So I can keep going on and on, but yeah, that was my last buy for the week.
Love that. Yeah, that was very helpful, especially because earlier in the week I commented under one of Fiducia's posts saying, it was the day after that 100,000 or $100 billion capex spending announcement was made, and I basically said, semis are roaring today. And then you commented about TSM, and then there was I've just been getting notifications for days about that. So it's very helpful to have some explanation as to that. So with this industry, you were able to name so many different tickers, right? TSM, ASML, KLIC, AMBA. If you had to pick 2 to 3 that you were gonna put your chips in and think, I'm trying to pick the winner here, who would those be?
Jesus Christ. Are you so what's your time period? Because
let's say 5 to 10 years.
All right, so this is a no-brainer. If you want just 2, it's the 2 companies in the world so let me just frame it this way. If I want to invest my money in a portfolio or in a company and I couldn't touch it for 5 or 10 years, I want a company that if the world if this company imploded and it was wiped off the face of the earth, the world would stop. Those 2 companies are ASML and TSM. For those of you that don't know, I'll just give a quick overview. TSM is the biggest third-party manufacturer of semiconductors. Samsung's right there too, but they're really the leader at advanced process nodes. So that they're really the company that your Apples, etc., go to produce all of their chips. And TSM is actually the company that supplanted Intel as a leading manufacturer back in 2019. So TSM is, and with 50% market share, they are we need you or the world is screwed. So that would be one. And then the other one was ASML, which I'll be quick here too, because I tend to gush about this company So ASML is a photolithography company, which basically, if you the way that chips are essentially made or etched is you shine a light through a photoresist or a mask, and that's how you create the design of the chip and all the transistors and the interconnects, etc. So ASML is the only company in the world that can produce extreme ultraviolet light photolithography machines, which any chip below 7 nanometers, that is the only machine you can use. Nikon and Canon, they produce some photolithography machines, but that can only be usually for DUV and older lagging technologies. ASML has 83% market share of the total market. They have 100% market share of the EUV market. And so these EUV machines, they go for about $175 million a pop. But with that being said, anything past, I think we're getting to 3 nanometers, anything past that, you actually have to use a new machine they've developed, which is, it's still EUV, but it's high numerical aperture, so HNA. And those machines are going to go for $300 million a pop. Wow. And if you just think about how they have to ship these machines, it's wild. But just really quickly on why ASML is the only company that can do what they do. And it's like, I don't say absolutes. I would say a very, very high probability that no company will ever, no matter how much money you have, capital, anything, will ever be able to replicate what ASML does, is because this is simply a engineering expertise problem that can only be developed through time and a lot of R&D money. So these EUV machines, what they're doing is they're melting tin, and they're basically dropping these molten tin droplets into a vacuum. And with a CO2 laser, they're shooting the droplet once to kind of open it up, and they shoot it again. And that second shot creates basically a little ball of fusion, and that emits extreme ultraviolet light, which is then captured by a mirror. It's bounced off of, let's say, 10 other mirrors, and it gets down to where the chip, to where the actual photoresist is going to be made through the chip, through the mask. The issue though is that when you create this EUV and you bounce it off these mirrors, the mirrors themselves consume a lot of that energy. So it just so happens that in order to create enough light that that'll be substantial enough to create the actual etching on the chips, it just turns out that they have to shoot this laser and hit the molten tin droplet 50,000 times a second just to make it all work. And then once it gets down to the wafer level, they have I'm forgetting how much it weighs. It's a 440-pound piece of the machine that they can accelerate faster than a fighter jet. So these guys, what they're able to do is just, it's impossible to replicate. They are the only company in the world that can do it. And, at a certain point in time, we're going to get, down to a node where not even extreme ultraviolet light can be used. And just really quickly, I know I'm rambling, but I find this shit fascinating. If you guys want me to shut up, please tell me. The reason why we had to go from DUV to EUV is because ultraviolet light's about 193 nanometers. So as you're shrinking your nodes down to 20 nanometers, 15, 10, et cetera, it's harder and harder to find different ways to shrink that 193 nanometer wavelength down to be thin enough to make it work. So what they did is they found a way to do EUV, which is only 13 nanometers in wavelength. And so it's a lot easier then and it's not technically this way anymore, but to create the transistor lengths of, 7 nanometers, 5 nanometers, et cetera. And what's really cool is that it actually just saw it. TSMC has been buying about half of all these EUV machines. And I just found out that TSMC is going to start producing their 3 nanometer chips with Apple by end of this year. So they're about like a half a year ahead of schedule. And just so everyone knows, to appreciate how this company is literally manipulating atomic particles, 1 nanometer is about 2 to 3 atoms in length. So they're able to basically create these transistors that are, about, let's call it like 10 to 15 atoms in length. And that gets into the quantum tunneling issue that I was talking about before, et cetera, et cetera.
Wow. That is an explanation right there. That
Yeah,
so for
I go into depth with these guys.
that's the depth. The good news is I think we have it recorded as well. So for anybody that wants to kind of re-listen through that, so you're fully understanding, I know I'm going to. That is going to be out not too late after this call, but definitely go take a look at those names that Chris was just hitting on: ASML, TSM. Fascinating graphs as well. They're really moving differently than a lot of the market is right now. So I highly recommend them. Our next speaker is going to be Parrot. Before we get to Parrot, real quick, for everyone that's on right now, just want to let everyone know that my name is Gav Blacksburg, and you're listening to the Weekly Howl. This is going to be a reoccurring series every Friday at 5 p.m., where I will be bringing on personalities and people from the internet, from really all different walks of life and investing, to talk about what they've been trading that week and what they're looking at the next week. So if you're interested in that type of stuff, please do feel free to join. Join the wolf pack, give me a follow, and I'll make sure that you're getting the best content possible. Parrot, go ahead, please, and break down for me what you bought, what you sold this week. I know that we do get your portfolio updates daily, but it's nice to get a little bit of a weekly recap from you.
Well, first I want to say how impressed I am, Chris. That was quite an explanation. I feel a lot smarter, and I don't know if I understood a third of it. So, but good job. um, so this week, first of all, I've run as I get the question a lot about kind of the large portfolio I run. I run about 40, 45 positions. I'm at 45 right now, and I just wanted to comment on what Jonah was saying about reducing it down to 15 to 25 names, and really I get this question a lot about how do I monitor 45 positions, and really about 20 of those are deep conviction positions. I'm not trading those regardless of what they do in the short term. So I'm really in that 15 to 25 name category too on positions I'm actually looking at every day and considering trading. So just to clear that up, because I get that question a whole lot. So this week, I'm going to start with the trade, with the sell, because I sold XL Fleet Thursday, and it's something that I probably should have cut a couple of weeks ago. I had been looking at cutting it and kind of went back and forth, wasn't sure, him and hawed about it. It was one that I really a mistake. I bought it, in the SPAC craze, back in December when it was still PIC, and it's really just kind of trended down from there. I almost sold it on Monday. I think I tweeted about it. I almost sold it on Monday when it was around 10, but with earnings this week, it was, kind of limited downside at that point. So I just went ahead and held it. Of course, the earnings weren't that great, and I ended up selling it Thursday morning. So that was my trade or my sell of the week. It actually ended up being my worst percentage loss since I've started this account. So it was just kind of a bad trade all the way around. I think I lost 50% on it. Luckily, it was a fairly small position, so it wasn't too bad overall. But anyway, let's get the bad news out of the way. For new positions this week, I have a little bit. Also impressed with your D&D there, Chris, because I have a little bit more. I guess Wild West. Whenever I'm starting new positions, I found something that I like. I'll go in and start a position. Usually pretty small spec position. It gives me a chance to watch it, monitor it, and it gives me some skin in the game. So I'll do a little bit deeper dive on them. So one position I started like that this week was MVVYF, which is Movely Media. It's a Canadian-based technology company. Basically, what they do is they take they allow users to take video and edit video and then upload to social media or whatever platform they want to use it on. It's supposed to make it's basically a video generator, make ease of producing video and then distributing it to multiple channels. And so I'll admit that I have more due diligence to do on them. It is a penny stock. Basically, I think it's running around 50 cents. But they had a lot of activity in the last month or so. I think in January they announced that they increased their bandwidth to 3 million users, including 300 of the Fortune 500 companies and some government agencies. They didn't say how much, but they did report dramatic, quote unquote, dramatic increase in traffic on their video streaming. and they just announced yesterday on the first, yeah, it was yesterday, that they've integrated with Instagram. A couple of days before that, on the 18th, they integrated with Twitter, and I think on the first of March they integrated with Microsoft OneDrive. So anyway, so they've got a lot of activity going, and thought it was well worth the spec position to start there. It I think they said I saw where the video delivery business is expected to reach 915 million by 2025, which is growing at about a 17.5 CAGR from 2018 to 2025. So it's got some growth there in that industry, and there's not a whole lot of players. So anyway, that was the first position I bought. Then I finally got back into KBNT, Kubient. It's one that I had started a position in. Oh, let's see, it was back in, I think it was December also. I had bought a position around, I think it was around $7 or so. They, it was at the time I was basically shotgunning it and bought a bunch of advertising. That's what they do. They're an advertising company, uh, cloud pragmatic digital advertising company. They have a platform. So I had bought several companies at the same time. I really liked that space. After doing some due diligence for a bunch of those, I decided to kind of concentrate down a little bit. Went to just basically TTD, Acuity Ads, and Magnite. So I sold them about the same price at the end of December, and so I missed that whole jump where it spiked to about, I think they spiked to $12 or $15, something like that. Kind of just dropped off the radar, and then a couple weeks ago, they dropped back down to 550, so it kind of got my attention. So I started looking at them again, and they I actually kind of I tweeted about that too, because I mentioned that I should buy them around 550, and I think the next day they started spiking again. I think they got back up to $9 or $10, uh, maybe $12. I can't remember how high they went a couple days ago. But then a couple weeks, let's see, when this happened, when the pullback happened, they got hit pretty hard, and they had a less than stellar earnings call. So um, it pulled back again pretty hard. So I decided to go ahead and start a position in at about 650 or so. And luckily, I guess the next day they bounced back up another dollar. So it's doing pretty good right now. Um, they just announced new partnerships with Google and Associated Press. They're working on developing a supply side to their Audience Cloud platform with a premium base of publishers, and they're continuing to scale the other side of that transaction with their marketplace with brands and their ad agencies to maximize the ROI. So they're doing pretty good. One thing I found kind of interesting is they broke out what they're calling the KAI, which is a standalone product. It's designed to detect ad fraud. And I guess they've executed a deal with Tron TV recently, which discovered some previously undetected fraud from their on their website. I think they were on the Washington Post website and the Weather Underground website. They found some fraud. So that looks promising as a standalone asset. So between that and them rolling out their full service DSP, along with the tailwinds for digital advertising, I thought it was worth a position to start, and I'll probably add to that position over time, depending on how they do in the short term. So that's
Very.
Go ahead.
No, I was just going to say that's a very cool summarization. It's so interesting to hear your thought pattern because I see you making these trades each day. You post and say, I bought this, I sold this, but I don't always get the chance to really hear your full rationalization, which is really nice. Something that you were posting about a bunch today, you might have just touched on it slightly, but NNOX. Talk to me about what's going on with NNOX, what your position is with NNOX, and where you see them going on Monday, because I know everyone's really excited for them.
Yeah, so they finally got the announcement that FDA approval for their single source X-ray. We've still got a ways to go there, but they've been posting over the last month or so. They're building a manufacturing facility. They've got orders. Things are going. But everybody's really been at the edge of their seat waiting on the FDA approval. I think that's just validation that this is a real deal. That the short reports, Muddy Waters had a short report that it was basically a scam. So I think they'll probably be looking to cover on Monday if they're actually still in the position. So, but yeah, it's just validation. I have how much do I have? I have 450 shares of Anox. And about 150, so about a third of that is really a swing trade for me. I bought it whenever, I think I bought it at 50 or so as a swing, and it kept going down. So shows what I know. Originally, I had bought them at 25 and 35, and I got lucky and got out at around 90, just over 90, and felt really good about it as it dropped back down to the 60s. Pretty much right after I sold, so I went ahead and bought back there, and it kept dropping down to 50. So obviously I got in too early, and I bought some more. I think I bought 300 shares at 65 or so, and then another 150 at 50. So I think that we'll be retesting highs here pretty soon. I think it'll be looking to try to get back up into the 90s. Where it goes from there, it really just depends on how they execute now on manufacturing. And they still have to submit for their FDA approval for their multi-source and their cloud application. So we still got a ways to go, but good news.
Very sweet. Love that news. Yeah, I have an Knox position as well. I'm going to flip it over to Brad in a second and then to Fat Baby. Real quick before I do that, if you're just joining, some of my favorite platforms to do research on, we hearing everyone talking about their research. I love doing research on Seeking Alpha as well as TradingView. And I've recently started doing some morning briefings from stuff like Finimize. And I actually like social sentiment a lot. I like to understand what the public think about stocks. So I use socialsentiment.io. And the cool thing is if you want to be using Seeking Alpha or TradingView or any of them, you can actually win free 1-year premium accounts. You just have to go to my pinned tweet. It's completely free. You just fill out a bracket. It's kind of like March Madness for stocks, ETFs, and cryptos. We're all the way to the Sweet 16, so it's actually a second chance bracket, so you have a really good chance of picking the winner. We've had upsets like Tesla losing to PLTR, Amazon losing to Baba. We just had XRP beat AMC and then won in the second round again. So if you want to be a little bit of stock picking and then you just come and can just vote on them on my profile, we've been getting thousands and thousands of votes on these. Just go ahead and check out my pinned tweet. But Brad, hope the sound quality is good for you. I'm turning it over to you. Would love to hear what you've been buying and selling this week.
Sure, and if it's not, just interrupt me and I can hop back in as a listener. No worries at all.
Nice, it's good.
Cool. So I am a little bit, or my process is maybe a little bit more boring than some of these others that we've heard from already. So I kind of I'm kind of a barbell investor. That's the effect of my process. And I've been using this bloodbath, for lack of a better term, in the growth stocks that I own to kind of really, really slowly add to the growth names on that barbell. And so the skew has become much more heavily pointed towards growth and away from value in the last several weeks and the last several months as sentiment kind of changed and as Viacom, which I held several weeks ago, just kind of went bananas and you use that as an opportunity to exit. But yeah, I am just kind of gritting my teeth through this ugliness and continuing to add slowly to the positions that I still see as being strong businesses and long-term growers, both in terms of revenue and profit.
Talk to us about a couple of those ones that you're adding to, those staunch positions.
Absolutely. So I'll give you two. So the first one is Olo. That's of interest this week because DoorDash dropped a 3-year-old lawsuit to the Financial Times to, I guess, resurface. But this was kind of highlighted in the S1, so it's not super concerning for me. But I did talk about it a lot the last 2 days if you want to see my opinions on that. But in terms of the company, it's in the food delivery business, but I like it because it doesn't actually do the food delivery, which I don't see as a super attractive business. So essentially, they are Shopify, but for large restaurant chains, and they're pretty large. So they're in 50% of the largest publicly traded chains, and they're in 50% of the fastest growing private market chains. So
this is not a small operation. They did just about 100 million in revenue this year. It got a large boost from the COVID tailwinds. I think they were up 94% year over year, and I'm not really expecting that to continue, but am expecting like a 40-50% growth rate for the pretty long term, just based on what I read in the S1. And more interestingly to me is they are the margins are fantastic. So they are net income positive. The operating margin inflected positive this year. So they are not really spending a whole lot of money to post the growth and the customer acquisition that they're currently boasting, which I find really attractive and really encouraging for what their long-term margin profile can look like. Just to kind of give you an overview of the company, they have 3 products. The first one's called Ordering. It's all private label. So I guess before I go into the products, I should talk about that. So Olo's thing is DoorDash and Uber Eats and Grubhub. They all kind of they take the brand away from the restaurant. So they are delivering the food. They are taking the order, and as a result, they're taking much larger margins than the restaurant would realize anyway. The restaurant chains aren't getting access to any of their consumer data from all of these from all this ordering, and yeah. So Olo comes in with this private label approach. It gives you access to every single delivery service provider. So that's their first or that's their first product called Dispatch, which selects from up to 8 delivery service providers to kind of let you make these providers price compete for your business, both in terms of price and timing and quality and all those things. So with Dispatch, you can coordinate. You can outsource whatever percentage of the deliveries you want. So a chain can be doing 100% of their deliveries in-house or 0%. It's really up to them. And this reminds me almost, it's weird to think about because they're very different industries, but the GoodRx model of allowing you to kind of look up a prescription and pick the lowest price based on whatever the most attractive PBM deal is at the time. So this is kind of doing that for the restaurants almost. So putting them in charge of their decision making and in charge of their brand and in charge of their data. And the other things they do is they build you websites. So that's where the Shopify comparison really comes in. They build you branded websites that allows you to take orders in real time and allows you to tweak your menu in real time and integrates with food prep kitchens and over 100 technology partners. So there's really a lot of value here they're creating. And there's the new product, which I'm really excited about, is called Rails. And what this does is kind of consolidates demand across channels, not delivery service providers and not marketplaces, but more like a Google Maps or Google Search. So it allows you to integrate all these searches within the Olo kind of POS system. So when a restaurant is taking an order, they're literally just getting a delivery order. They're not getting an order from Grubhub or from Uber Eats or from anyone. They are taking in all these kind of bids, for lack of a better term, from all these delivery service providers, picking the best one and running with it from there. And what this also does is, through a partnership with Google, is allows them to place menu items directly onto the Google search page. So this is also cutting out the delivery service providers, the marketplace, to kind of fatten up these margins and put the restaurant chains in control of their brand. And why this is so appealing to me is there are surveys out that you can look at, but anywhere between 65 and 70% on all these surveys, the consumers are saying they would much rather order from the brand directly. They don't want to order from DoorDash. They don't want to order from Uber Eats. They want to order from the restaurant. And what Olo is doing essentially is allowing these legacy restaurant chains to do that. They're allowing them to evolve and modernize with the times without shipping off 30% of their profit margin to another company. So Olo is taking profit. They're not doing this for free, but they're taking a much smaller cut and really giving restaurants access to all their consumer data so that they can make better menu decisions and make better kind of presentation decisions. And they're really putting the restaurant back in control of their business. Founder led, really like that. Glassdoor ratings are phenomenal. The big risk here is they do use DoorDash a lot. So if DoorDash decided to really build out their private label product that they're kind of flirting with right now, it would maybe be a little concerning, but good to remember that DoorDash is kind of locking these consumers in to the DoorDash delivery ecosystem. So you're losing this ability to use the good RX price compete for my business. So I don't really see that as a huge threat. And I know that kind of ran long. So if you wanna go over to Fat Baby Funds, I can skip the last one for now.
Yeah, no worries. I'll definitely touch the Fat Baby, and we can definitely hop back as well. A couple things I
I
wanted to
literally
touch.
rambled forever, Brad. You can talk.
Yeah,
Thank you.
I'm getting in all my DMs. Chris has to go last next time. But Chris, we love the
Just don't let me
passion.
go.
We love the passion. That's what shines through more than anything. Chris, when Chris speaks, it's a type of speech that you hope is recorded so you can like listen to it a couple times because it makes me it's like the finance version of wanting to run through a brick wall. And
He's kind of making me like reconsider being in Qualcomm and maybe I should be in SMH because a lot of that stuff he said just kind of went over my head. So I am questioning my understanding of the space at the current moment. Chris,
Brad, I'll ping you on Slack if you want.
sure.
But yeah, what was the question?
What ETF would you recommend for somebody wanting exposure to the space?
Yeah, SMH is good. I have SMH in my IRA. I was getting questions about some of the levered ETFs today. The issue with those is that there are some that actually have exposure to it. They're technically chip companies, but some solar companies. But SMH is really good. I think that they are heavier weighted towards TSM, which I just think is probably the safer, but also consistent upside ETF.
Cool. Thank you.
Yep.
very, very cool. So real quick, before we go to Fat Baby, we have a great speaker panel up here, and there's a lot of listeners. There's a few people that have requested to speak throughout. I've gotten one or two DMs. If you have a question for a speaker, feel free to DM me. Feel free to just tweet it out. I have like a few screens, so I will definitely see whatever you tweet at me or DM me. If you have a question, if you want to go to a specific speaker, that's totally fine. I have one already that I'm gonna ask afterwards. But before we hop into that, Fat Baby Funds, as always, I really like your style. I feel like you are never scared to buy the companies that you're interested in. I remember when SFIX was falling, you were tweeting, "There's blood in the water, but I'm a shark," and just the mindset of which you're buying and selling. So walk us through this past week for you.
So I invest a little bit differently, but I think it's a style everyone can sort of do. I try and buy and hold great companies. So I've identified 20 companies that I think are great. I share a list on my website, fatbabyfunds.com, or there's a link in my bio to it of a Google Sheets tracker of all of them. But I basically try to find great management at a semi-reasonable price and then buy and hold forever. So I don't sell very often. I didn't make any sales this week, but I did make 2 buys. So I added to my Amazon position. A lot of people are scared by the market cap of Amazon. I still think it's still very early for Amazon. And to me, they're still experimenting. They're still showing the optionality. They're still the monster that everyone is seeing out there. So I'm not scared to buy them at a $1.5 billion market cap because I think in the future that we're going to look back and it's going to be sort of like Apple back in 2011. So everyone was scared. Apple was a top 3, top 4 company in market cap in 2011. And so there's always all the rumblings that you don't get the growth. You don't get the same level of returns from the higher market caps. And when you're talking about a company that's still growing their sales 40% at the huge amount that they are, and they're still constantly investing in themselves, I still see their moat widening. I see the last mile. The other day outside of my house, I saw an Amazon driver stop and deliver 3 items to 3 different houses in a row. They're just dominating the market. And then on the other end of the spectrum, there's Shopify. Very different, arming the rebels kind of company versus Amazon, but I think they can both coexist, and they show a lot of the same kind of traits where they started as one type of company and they've evolved over time. And what they are right now as a $100 billion company, some people might look at it and say the valuation's too rich. What they do there isn't the opportunity to deserve that kind of market cap. But the reality is with these kind of companies and with leaders like Toby, that they're going to pull some TAM magic and they're going to enter new markets via their optionality. Shopify is doing all kinds of weird things like gaming, but they're really solving the entrepreneurs' problems. And they're starting to build out their supply chain as well and constantly investing in themselves. So those are the two companies I bought today. And I'll just keep buying them. Just keep buying great companies, keep holding great companies. I don't pay as much attention to the short term, what's happening in the short term, as much as what are they doing for the long term? How are they investing in themselves for the long term? And I see Shopify and Amazon doing great.
Definitely. Those are two huge companies that are just going to continue. I actually did a podcast on Shopify about a week back, and I asked Connor. So his name's Connor Gross, I believe. You can find him on Twitter at Connor Gross. Super interesting guy. It's at C_GRO. So Connor has actually built multiple seven-figure e-com businesses on Shopify. And he did that while he was still in college. He was selling over $1 million worth of products. And his favorite thing about Shopify over Amazon was how much they help out the seller. And by that, he meant they basically educate you through every single step of the process. It is how many people put your product into their cart and then didn't finish. How can you change that? What can you do to change that? How can you best use the platform, marketing strategies? And he really spoke to me about that. I think that's really powerful in comparison to something like Amazon, where they're just such a monolithic giant that they don't maybe have the time or resources to go and do that for everybody, or that was just not their DNA as a company. They were just, the DNA is we're everywhere. We're Amazon. We're the biggest. If you want it fast and quick, you're going to buy from us. And Shopify is more like, we're going to help you. We're going to take you through the steps of the process. How do you see them stacking up to each other?
I mean, to me, when I look at Shopify versus Amazon, they're sort of different companies, and they have different problems, but they're going about it in two different ways. And I think Amazon's at a different life stage in their company where they're really building out that last mile, and then Shopify's in the stage where they've solved a lot of problems, and they're just starting to hit the really big problems that if they're able to solve, they're going to be a monster company. And the two biggest problems that they sort of are running into is, okay, you solve all these problems for these entrepreneurs. You do a great job. You make it easy. But how do you help with the problem of search? How do you help people find those products? Amazon does a great job of that. Shopify is sort of the way they're built, they don't have that. But I think that's the biggest problem for entrepreneurs. So if Shopify is able to start to solve that, and they have taken steps with the Shop app that I think long-term, and their partnerships with Facebook, I think long-term that's something they'll solve. And then on top of that, the distribution is a huge problem for everyone. And they're starting to build out their supply chain. It's still completely crazy when you look at it, how much Amazon is spending in CapEx building out their supply chain versus what Shopify is doing. But they're two companies that are at different stages. So I do think that they'll both coexist and both do very well in the long term.
Okay, I like that. That's a good breakdown. All right, we have a couple questions from the crowd, from the listeners. So please continue to ask your questions. Feel free to DM or to just tweet at me. Either way is fine. I've also invited a couple people from the crowd. If they want to be speakers, they can come up and share their weeks with us. But for right now, the first question that I have is for Stock Market Nerd, for Brad. And it's a question from Degenerate Socialite. And they asked, can you touch upon the difference between OLO and FOUR? FOUR is the other stock.
Yeah, to be honest, I'm not super familiar with FOUR. I know it's a fintech company, but yeah, I couldn't speak to that.
Yeah, I'm just taking a look at it right now. So FOUR is called Shift 4 Payments, and they're a holding company with interest in providing secure payment processing solutions. I'm not totally familiar with them as well. If any of our other speakers are, feel free to just chime in. But If not, so someone asked a question for Parrot. Then they said, actually, never mind. But it's an interesting question, so I actually want to ask it. So Parrot, they asked about a 1x 1x1 strategy of screening annually. Does that ring a bell?
No.
Okay, fair enough. It was a screening annually process, but continuing to get. Okay, thank you, Ernest Kaplan. Really appreciate the thoughts there. Okay, so my question, I'm just going to actually throw back to Chris because I know Chris, it's been a second since you spoke. You're a serious expert in the area which you spoke about. What is an area that you are consider yourself not an expert in the stock market, and it's an area that in 2021 you would want to learn more about? You would want to become more of an expert and be able to talk about another area the way you just broke down, semis to us.
Oh, I'm sorry. Was that for me? Hold on one second.
Yes, sir.
Can you repeat that?
Yeah. So my question to you was, you just came at us with some impressive knowledge covering semis, and you're such an expert in that area. I was wondering, what's another area of the stock market that you are not an expert in, but you would like to become an expert and be able to talk about it the same way that you just talked about semis in 2021?
I wouldn't say I'm an expert in semis. Far from it, actually. I actually, if you go to my profile, I had a few, I think it was replies. I tagged the guys that actually do know semis. I am just a baby when it comes to this market. A few people to look up are Fool All the Time, which is Mule, Dylan 522P. And then, the guys at NZS Capital, like Brad Slingerland, those guys. So I don't want anyone thinking that I'm some expert or I know what the hell I'm talking about. I'm just trying to figure it out, kind of like I do with everything else. Another part of the market that I want to, I guess, study. Well, I mean, I'm still all on top of the SaaS names that I covered last year, that I started covering last year, I should say. That's not going to change because I think like everyone here has said, there are a lot of high quality companies out there that are really transforming the world in the way that we are able to live as humans. So that's never going to change. So maybe something else is that. So I mean, one that I did want to get, one area I want to get involved in was alternative energy. So this kind of goes somewhat in line with semis because these, at least the solar companies also do, they need to create their own chips. But alternative energy, I think, it's a next 40-year, 50-year type of play. I do want to start learning more about, at least on the wind and solar side. I think those are, the two renewable sources that are, I know a little bit about the space, but I don't know a lot. Those are the two sources I think that are showing a lot of scale. So a lot of improvement in terms of watt per, really cost per watt. But really the reason why I'm so fascinated with alternative energy is I want to track the developments that we have when it comes to fusion. So fusion energy has been like promised and thought about for like 50 years. And we keep thinking or saying that we're getting closer and closer and closer. But this kind of goes back to my rant the other night. Just figuring out and talking about quantum mechanics that's allowing us to make more and more progress on the fusion side. And so once we get fusion to work, which the current estimates are around 2040, 2050, that will be the only renewable source we'll ever need again. Because what fusion is, and it's what happens at the center of the sun. It's basically hydrogen atoms forming into helium. It releases an electron, and that's energy. So that's kind of a space that I'm really interested in.
Okay. That's fascinating. Yeah, I love that solar industry as well. I think my largest holdings right now are actually slightly focused in that area. I did want to look more into SCDG as well. But we have now several questions are kind of coming in, so I'm going to throw them out a little bit rapid fire. To our speakers, if you can answer in probably like 30 seconds to a minute or two, that would be great. So first, Brad, you messaged me that you're ready to answer that question.
Yeah, so I guess high level answer is Schiffer Payments. I just read their product suite. Kind of reminds me more of a Square, and that they're both kind of just broad fintech companies that service every industry. And I know Square is building out a restaurant product sort of somewhat similar to Olo with a lot of overlap. So it should not be misconstrued that there is a lot of competition here, and there is a lot of proving left to do.
Okay, great answer to that. All right, I actually now have a question from Investment Talk for Fat Baby Funds. So this is a pretty interesting one. But before we get into that, real quick, if you haven't yet, make sure that you're checking out the pin tweet in my profile. We're running this market madness. It's kind of like a March Madness for stocks, ETFs, and cryptos. And we just reopened it. So we had closed originally all the bracket submissions, but we actually just reopened it literally an hour ago for second chance submissions. You can win plans from Seeking Alpha, from Finimize, from TradingView, and from socialsentiment.io. And some people are asking me, they're like, are you paying for these plans? We're not. Literally, I was on Zoom with the CEO and founder of Seeking Alpha, David Jackson, last week. He loves what we're doing with this. He wants everyone to participate. For the Seeking Alpha one, you do have to have a free account made by the 5th, but it's just a free account. You don't have to pay any money. You don't have to put in a credit card. You just have to make a free account. That's the only clause for that one. All the other ones, you just have to submit, and you could win. You know, that TradingView premium is literally $600 a year. So you could win that. The other packages are pretty pricey too. So make sure you're checking out my profile. And then again, this is the weekly Howl. We're going to have on a bunch of different speakers all the time, every single Friday at 5 p.m. EST, and you'll be able to hear stock talk to the next level. Now, pretty cool question for you Fat Baby Funds from Investment Talk. And it's a very IT type question. He said, Fat Baby, give me a raging bull case for Etsy.
Oh man!
Yeah, so I want you to imagine this was a company, right? And
Chris, you got to mute out.
And so I do own Etsy. I do plan to sell Etsy at some point. But to me, the bull case for Etsy is you have this amazing marketplace that they've built, and then on top of it, you start to build all these different value chains on top of it, sort of similar to what Amazon has done, where you help your decentralized seller base to create their products. You help them to distribute their products. You start to build the Etsy brand with physical Etsy stores, where you bring all the different Etsy sellers' products into a physical store, and you put those in the biggest cities to sort of help the brand. And then on top of that, you just keep building all the different ways you can add value. And then you can even start to get a little funkier than that, where Etsy starts selling NFTs in the future. Etsy becomes the artist marketplace where artists are selling their NFTs, and it's basically just easy money, easy marketplace money, but they defend that with a big value moat that they build by making it difficult to replicate with all the different value adds that they could do with production, distribution, everything like that. So the sellers will never want to shift away from Etsy.
There we have it. The roaring bull case. Love to hear it. Feel free, IT, if you want any other bull or bear cases, just DM me. I'll ask away. All right, more questions coming in. All right, Parrot, I'm going to throw this one to you. So Connie said, can you cover or ask about Open Door? What are your thoughts on Open Door?
So I really don't know a lot about them. I haven't looked into Open Door a lot. So I'm probably not the best person to ask. I'm really not in that space right now.
No worries. I can throw it around if anybody has opinions. Brad?
I got nothing.
All right.
I got nothing.
All right, well, I'll throw my personal opinion. I'm actually definitely a fan of this space. I love this real estate space, whether you're looking at something like Open Door or you're looking at Z for, Zillow Group. I have exposure to both personally in my Roth IRA. I'm just trying to find the winners. Anybody that's looking at real estate over the past few years knows that industry is booming, knows people are trying to find more ways to easily connect with sellers and buyers and sell their house. You have these platforms like Zillow and I guess a little bit of Open and XP, EXPI that are now coming in and they're kind of middlemaning the market. They're removing the need for a physical broker person because you can go ahead, and it used to be with something like Zillow, you would say, okay, that's where I go when I look for new stuff and I get a Zestimate maybe and I check it out. But now you're actually moving to the stage of buying and selling the actual properties on these type of platforms. And, Open, I think, is recreating some of that magic. So I love the area. I'm personally having exposure, not investment advice, but I would just continue to keep an eye on them. I believe Open was also a SPAC, I think, came from a SPAC, perhaps a Chamath SPAC. I'd have to look more into that. But I would just keep an eye on that area. I don't know who the dominant player is going to end up being. That's why I'm personally holding 2 or 3. If that's not your strategy, I totally understand it. You just want to kind of shoot for one. That's fine. I would personally go with Zillow Group, but I just like holding a couple because why not? All right, next question. All right, maybe I'll just throw this out and whoever knows best can answer. All right, so someone asked, are we out of yield and inflation fear? Is it growth time now? Parrot?
Oh man,
or Brad?
I mean, whoever. I mean,
The right
kinda,
answer is no one fucking knows.
Thank you.
and go ahead, Brad.
Yeah. I was gonna say that a little more. Yeah, with a little more fluff than that. So I guess I'll just echo that.
Yeah, I'll echo that.
I think Chris covered.
So yeah, and I'll provide a little more color. So, anybody that tells you the direction of a stock or a company, whatever it may be, they are full of shit because nobody knows. In the short term, this is a truism. The stock market truly is a voting mechanism, right? Long term, it's a lot easier. This short term treasury movement and inflation scares, it's short. Like nobody knows what's going to happen in the next 6 months or a year. So what does that mean? All you can do is find the highest quality companies that, based off of your research, you believe are undervalued relative to the market's expectations and that you expect to compound over whatever your investment horizon is. That's all we can do. Worrying about macro factors has lost people a lot more money than it's ever made.
Yeah, and I'll just add to that. I agree with everything that was just said. To me, a 2% 10-year or 2% 5 or 2.5% 10-year, I won't be predicting it. I'll be 100% reacting to it, not predicting it because I really have no clue. But that is still a very favorable environment for growth stocks. And I know people are a little bit panicked about the pace of this yield rise, but if we kind of level out at even 3%, I mean that is historically speaking a very favorable environment for long duration assets. It's not as favorable as it is right now, but it's really it doesn't make me panic. It kind of just makes me want to wait for other people to panic so that I can buy more shares of my favorite companies.
It means the economy's strong. That's
Yeah.
what that means. And historically, you want a strong economy for the stock market. They're not related directly, but a strong economy means more cash flows for companies, means more value for shareholders. It's kind of that simple.
It's just that simple, folks. You heard it. So a couple of things. Real quick shout out to @BlueSuitDylan inside of here. Dylan just tagged me in a post where he explained that the big players for no agent brokerages are RDFN, which I also do hold as well, Z and Open. EXPI, he says, is changing the game from the compensation structure of the agent side of things. And the biggest question is, do you think an agent will become obsolete long-term for the biggest purchase of their life, right? A house is for many people the largest purchase of your lifetime. People are paying these off over 30 years, although of course they're paying it off typically a little bit sooner, but that's a typical mortgage. So are you comfortable going ahead and making that purchase with no interactive personnel in between? So it kind of is what's happening with cars right now. We used to see nobody was really buying a car online. Everyone was going into a store. You had to feel the car. You had to touch the car, drive the car, talk to the people, make sure that they weren't scamming you, all these things. And now you're just buying the car online. So yes, I do believe that with the way that the world's going, especially with coronavirus, that people are going to be comfortable making full house purchases without having that necessarily interactive broker. I think that they would love to have a tour around the house, but literally, I'm personally looking at the Miami area. I can do these virtual tours. I've been looking at a bunch of places and they just do virtual tours for me. So it's pretty interesting to see. All right, we have a couple more questions. So this one I think is going to be a tough one for the people to answer, but Parrot, I'm going to throw one back to you again. I was asked any suggestions for a Roth IRA portfolio. They are interested in ETFs and growth stocks. Thanks.
Wow. Well, no direct no direct recommendations, but I mean you can see the stocks I'm interested in. I post them every day. So a Roth is interesting because you know it's you can trade tax free and it's all tax free when you get it out. So um, I don't know. I don't personally have a Roth. I have a traditional. So I don't know that I'd treat it any differently though if it was a Roth. So I don't know. I'm not sure what the tax implications are. Maybe somebody else could help with that has a Roth.
Yeah, any big Roth guys in here? Nobody? I have a Roth. Brad, do you have a Roth?
I'm a freelancer, so I do not have a Roth at the moment.
Wow. Okay. Fat baby Chris, no Roths out here? All right, fair enough. I'm rocking with the Roth. I don't know if you should be holding everything that I'm holding in your Roth. You know, I'm just younger, so I have the tax advantage of getting into it now. I do have Open as well as ZG. Both are in my Roth. And then I have a couple. I picked up ZMDTF. That's one that I kind of got from Parrot. I have some Skills, some Lemonade. I got like a nice curation from all my speakers up here. Maybe I'll have to add some semis and then I will have the full package. But all right, we have some more questions. All right, I'm almost scared to give Chris another semiconductor question, so I'm gonna wait a second on that one. But but we'll get back to it. All right, so Parrot, can you give 30 more seconds on what it means for NNOX to get FDA clearance?
What it means, well, basically, it's confirmation that their technology works, and so I think that just gives everybody a good feeling that it's a real company, right? So they're gonna make products, they're gonna be successful, their business plan's still a go, right? So I think it's a huge deal because that's really the major hurdle. I think Brad posted something about it recently or a little earlier that this was the major hurdle for them to conquer. Now that they have the first FDA approval, the multi-source is basically the same technology, just more of them. So, strung together. So, I think this was the hurdle to prove that they're a legitimate company.
Like that. That was a good little one there. Oh, also, Fat Baby Funds, I'm throwing it back to you. Apparently, I misread IT's question. I asked for the bull case for Etsy, so now I'm actually going to tear your heartstrings out because I want the bear case. So, give you the other side.
The bear case, and this is sort of what I've been arguing with people on Twitter on, is that they have done a great job building up the search, but what they haven't done is really added value on top of their marketplace. So if your only moat is due to network effects, I don't know if that's really a moat long term, because if you're a marketplace, how come Facebook Marketplace, Instagram shops, all that kind of stuff can't just shift over at some point with a larger network and overtake you with less of a cut? Because Etsy takes a sweet cut of every transaction. They make a ton of money. They're a great company, but I don't think they add enough value long term. So the bear case to me is that search isn't enough. Right now, what people defend them long term with is that they have the power of search and they have a great brand. I don't think that's enough to be a great company. I think you need to be layering extra value on top of that, as all the other great companies have. So long term, I see them being disrupted unless they start investing in themselves, really finding a way to add more value than just search. To me, search isn't enough for the big cut they're taking.
Okay. Appreciate that other side of things. All right, Chris, I'm giving you a couple of questions here. Let's try to do like 1 to 2 minutes on each. So the first one comes from our very good friend Fiducia, who's right here. And Fiducia...
True that guy.
Oh, okay. All right. Moving on to the next question.
No, I'm kidding.
I'm kidding.
I'm kidding.
Don't worry. We love Fiducia here. All right. So the question is, how much do you think is already potentially priced into current equity prices for semi-names? He said he loves the semi-names that you mentioned, and he owns LRCX, but he's just curious about the execution and about how much is already priced in.
It's company dependent. So there are some that certainly I believe at least are priced. I think in line with at least how I expect them to perform. So there's not really a lot of more juice to squeeze. So like ASML, I'm not going out and buying right now. But on the other hand, like Kulik and Sofa that I was talking about, based off of just price implied expectations, it should be at like $60 right now, $58 right now, and it's at 50. And that was after a big run this week. So it really is case dependent.
Okay, appreciate that. All right, quick follow-up question in that semiconductor industry. This one's coming from Ernest Kaplan. And Ernest, I just want to say I really have appreciated, you've tweeted a couple times during this space, your appreciation for it and for the speakers. And I just want to echo that. Huge thank you to my speakers that are here. These are people that have been guiding my investing journey, and I trust but verify, of course. I do my own due diligence, but it's very helpful to have them as part of my community and to be able to interact with them. So I highly recommend to all the listeners on here. We've had almost 300 people on here throughout. Go ahead and just give them a follow as well. You really can't go wrong. Parrot is openly sharing that $1 million portfolio, that baby funds, consistently attacking the market, even in times of blood in the water. Chris, clearly, although he wants to claim every single time that he's not an expert, is more experienced than us in a lot of these areas, and it really does show through. And then Brad is consistently finding amazing positions, whether it's Lemonade on that early finds with the deep dive into these companies, and several others. I highly recommend them. All right, so back to Chris with another question, this one coming from Ernest. So he said, the semiconductor has typically been a very cyclical business, yet stocks like TSM and ASML share prices have just consistently gone up for years and years. Do you see, Chris, any of this cyclicality coming in over the next few years, possibly, and bringing them back down?
Oh, man. How long do I have?
Let's do 2 to 3.
All right, I'll try. This is one of my favorite topics. Yes, it is a historically cyclical business, but you do have, I'll just talk about first the supply and demand dynamics. So longer term, supply and demand are going to be imbalanced relatively. Demand, as you all probably know, AI, 5G, IoT, et cetera, has a massive demand tailwind for it. All those need semis and different kinds of chips, et cetera, et cetera. On the supply side, I think I touched on the issue with geometry scaling and transistor densities before. They're trying to move to advanced packaging, like I mentioned, but that can only do so much. Once we get to lower process nodes, say like below like 1 nanometer, it's going to be so difficult to continue producing these chips from a pure physics standpoint that you have just a natural supply shock baked in. So that's longer term. Shorter-ish term, over the next 1 to 2 years, these companies are going to print money. And so just a quick comment, there is value throughout the entire value chain. It's not like a smile curve. Like every single part of the supply chain can have good opportunities. But over the next 1 to 2 years, just talking about general, on the chip side, on the manufacturing side, they're right now at about 14 weeks of lead time to get an order and produce the chip, which is the worst that's been since 2018. And anything more than that, you're going to start seeing inventories really start to dwindle to dangerous levels. I don't think it's going to happen, but that's kind of where that is. The fabs are running at 96% capacity utilization, and usually 80% is what you would see in a bull market. So there's not a lot of room left. And then on the equipment side, these guys also have really insane lead time. So it's about throughout the rest of 2021 into mid 2022 are the lead times to get an order and send it out. So there's just a backlog throughout the entire industry that's just going to jack up prices. And that doesn't even, I haven't even talked with the memory side. Micron just had an incredible earnings announcement. because DRAM, so memory or short-term memory in the any sort of electronic device, DRAM is in a just about as bad a supply and demand imbalance as everyone else, as all the other chips. And Micron's the leader. They have like one of the leaders. They have like 30% market share there. It's 70% of their business. So it's like wherever you look, you have this supply and demand imbalance. It's not going to go away until, best case, like early to mid 2022. So we're in a secular bull market for semis. Let's call it the next at least 10 years. There will be some cyclicality, but it's going to be, in at least my view, a lot more tempered, I should say.
Okay. That was a pretty strong answer. And definitely, I hope that answers your questions, Ernest. All right, we have a ton of questions coming in, so I'm definitely going to try to rapid fire off a couple of these to get through them. So this is an interesting question. I'm going to throw at you, Fat Baby. Oh, I'm sorry to see Parrot had to leave, which is unfortunate because we had some SE questions. But Fat Baby, all right, interesting question. They asked, where do you see the puck going? I guess this is in relation to the market. They're trying to quote Gretzky, essentially saying, where's the puck going versus where the puck has been going the last 3 to 5 years, right? You're a long-term investor. You've felt the flow of the game, per se, with the market. Obviously, we've had this 10-year bull run. Where's the puck been going? Where do you see it going, let's say, next 3 to 5 years?
Forecasting the future is always hard, and that's why I'm always preaching the importance of optionality. Optionality, really, the whole purpose of it is the low-cost experimenting with asymmetric rewards can create scenarios where you have less path dependence. So when you're trying to forecast things out, no one would have guessed COVID 2 years ago, anything like that. But if I had to guess on what the future will be, I think there's a few key trends going on right now. I think social commerce is going to be huge. I think that the golden age of audio is just starting. We're all on this audio platform right now. I think Spotify is going to be huge. I think digital nomads, remote work, everything like that is going to keep coming. I think travel is going to bounce back like crazy. I think business travel might not. So everyone who's a travel stock bull, you sort of have to pull out what is the average person travel versus business travel, because I don't ever see business travel coming back the same way. So it's hard to say. And then long term, I just expect things to be crazy, like they have been. Every 5 years you look back and you say it's been a crazy past 5 years. So I'd expect the next 5 years to be crazy too.
Yeah, definitely. I think with this amount of money being poured into the market with QE, no stop to that in sight, inflation where it's at, getting back to this fuller economy, we're at 6% unemployment as of today. There's no reason to believe that the craziness won't stop. I agree with you. I think we all hope that this bull market continues. I don't see an outstanding reason why it should not, but it's nice that we're having, it's tough, right, for our portfolios over the last month or two that we're having these pullbacks. But if the market had continued on the trend which it was at, which most people were already up 40% for the year in a month and a half, 2 months, and people were up, it's April, most people who are not even strategic investors are up 80% on the year. That's a problem. That's when I would really start looking at things as a bubble. But if we continue to get these pullbacks and people shift into different areas of the market, right? An area pulls back, they buy into that, they get into some value, they continue to have stability, diversity. That's what really makes me comfortable with saying, yes, this is going to be a wild ride for 3 to 5 years, but I'm here to enjoy it. All right, let's look at a couple more questions. We're going to try to wrap this up before 7 because I know that my speakers have stuff to do, and I'm just really appreciative to have them, but I'm getting a ton of questions, so I'm going to throw them out. Let's go with this one. Does anybody, first off, to my speakers, I'll just say, because I have 4 of them on, does anybody know anything about CPNG? Real quick, anybody want to talk on CPNG? I have a question about their possible expansion to Japan. Anybody know about them? All right.
I know about them, but not
Coupang.
About them.
So I know Coupang's a pretty big company. I have not looked into Coupang. I know that there's a ton of hype behind them. Any thoughts from the crowd on Coupang and their expansion to Japan? Chris?
Yeah, and I'm gonna. Yeah, so sorry. I know about them and I know a decent amount, but I don't like to
Mhm.
opine on stocks that I haven't done my research on. So
Fair enough.
nothing here.
All right, nothing on Coupang right now. To the asker, feel free to come back to another call, and if we have someone on that can talk about it, they will. But I'm going to circle back. Okay, so uncommon yields. Thank you for joining us. Appreciate you coming back post-workout to chat. So I wanted to ask you a couple of things. First off, congratulations on your champion. So Uncommon Yield is backing Square in the Market Madness tournament. If you want to learn about Market Madness and how you can win a bunch of prizes, you can go ahead and check out the link in my bio. Rip Chris, we drove him away by asking him about Coupang. But okay, so Uncommon Yield talk to us first off about that Square just dominating CELH across the board, even though Jonah was backing CELH. And we've seen what that can do when, DMTK is going on fire. And then also just talk to us about what you were buying and selling this week and what your mindset is going into next week.
Yeah, well, thanks for having me on. I was a little bit surprised to win. Celsius is a great company. Jonah obviously has a massive following. So, to get the victory there, I was really, I was surprised. I thought I had a 50-50 shot. I just think it speaks to the power of Square. People really know the company. People really love the company. People have Cash App. So, not super surprised to win, but, really, really, really pleased that I pulled it off. As far as what I did this week, so I really didn't make a whole lot of buy or sells. I have an options account I messed around with a little bit. I sold a cash secured put there on BlackBerry right before earnings. Made a little bit on that, but not a whole lot. I also added, I have just a passive brokerage account that I add a little bit of money to every day. And I hadn't had any big Bitcoin exposure in there. So, it really is a bummer. There's not an ETF in the United States yet. So I did decide to buy a little bit of MicroStrategies. There's two reasons why I started to put that a little bit in that, put an allocation there in M1 finance in that pie that I have. And so one, they're trading pretty close to actually the underlying value of Bitcoin. So if you look back, I have a post that I posted, on Friday why I added it. You can tell that the premium that you're paying for the Bitcoin compared to the underlying stock is one of the smaller percentages we've seen, and there's it's really not a whole lot more than what the stock was trading for just in and of itself back in August of earlier this year. And we all know that multiples have expanded. So I feel pretty comfortable with that. And then what Michael Saylor, the CEO of MicroStrategies, is continuing to show that he's going to do is add more Bitcoin to the balance sheet through free cash flow. So they made a buy in December, January, and February. I'm sure they're going to announce a buy in March here as well. So I think not only did I buy a little bit of Bitcoin now, like what it's worth now, but that the value that's only going to grow. And, I really wouldn't be surprised too if we see Bitcoin at 100K later on this year.
So real quick question for you, actually. So I got some feedback on our Square podcast, and I was told that we talk too much about Bitcoin and not enough about Square's own merits. So maybe give us like the 2 minutes, because Square has a big matchup. Obviously, in this next round of Market Madness, it's going to be going against probably DMTK, the way it's looking.
Yeah.
You have to go against Jonah again, right? DMTK is obviously Jonah's baby here. It's saving lives and stuff. So talk to me about like Square's, merits to the company itself, maybe for a minute or two, and just like why outside of all the Bitcoin stuff, Square's a fantastic company.
So I think Square has four things going for it. And I always mention cryptocurrency just because I think it is a big deal. I think they do have the Rails. They're starting to build that out, and that is going to be a big deal. We've seen Visa make some announcements in the last week saying that they're going to accept payments in USDC, which is a stable coin. I think we're going to hear something from MasterCard pretty soon. I've been talking to some people that have kind of alluded to that. I think the other thing that's really going for Square is Jack Dorsey. He's just he seems to be a forward-thinking CEO. He seems to be pushing all the right buttons when it comes to Square expanding. Their new foray into music, bringing Jay-Z on the board. I think it's really interesting, trying to get into that creator economy.
I think the Cash App, it's grown 100% the last couple of years, just the average monthly users. That's a really big deal. And then I think people aren't talking about it as a reopening stock enough. So a lot of, their original business was point of sale payments, a lot of those are small restaurants, small retailers, that's all been shut down for a large part, and a lot of those have been in bigger cities. They made even a call out in Q4 notes about how big of an impact that made. They didn't put a dollar number to it that I saw, but I imagine it was substantial. So I think once we see that come back, that'll be a big deal. They were profitable in 2019. They made $420 million. They lost a little bit of money in 2020, but that's because of investment and obviously COVID. So I think we're just going to continue to see revenue expansion from Square, and I really think once things reopen, which will hopefully be soon with the vaccine, that it'll just continue to be strong.
Very cool. I like that backing there. Okay, Brad and David, you're my last two standing. Parrot had some stuff with family. Chris had some stuff. So let's do like 5-10 more minutes, and we're gonna wrap up. Just some rapid fire questions for you. So first off, either of you have any thoughts on Futu?
So personally, I do not, a little bit too much geopolitical risk for me there.
Okay, fair enough. I actually really like Futu. I've been long Futu since about $45. I think if you look into Futu, it's basically like Robinhood kind of crossed over with Reddit, a bit of that social investing area, which is actually what Wolf Financial, the company that I work for, is focused on. For everyone that's listening, if I haven't introduced myself, my name is Gav Blacksburg, and I'm the voice of Wolf Financial. I'm the host of Market Madness as well as the Weekly Howl. You're listening to the Weekly Howl. It is a once a week on Fridays at 5 p.m. I will bring on several of your favorite investors and creators from the internet to talk about what they're trading. So make sure you're following so that you don't miss out on these type of spaces. Thank you to Twitter for making me a beta space holder. Okay, another question. Brad, this one is directed at you from Andrew Holder 22. He said, Brad, what are your thoughts about JFrog in terms of growth prospects and optionality?
Yeah, I think JFrog is it's kind of in the gray area almost. It doesn't grow fast enough to be sexy for growth investors. And it doesn't quite have enough free cash flow to be attractive to value investors. But it does boast 35% top line growth, and it does boast free cash flow, and it does have a really favorable margin profile. So in terms of how they grow, I don't want to compare it to CrowdStrike because CrowdStrike has had several more quarters of proving and execution and just wowing everybody. But how JFrog is going to grow is by adding to this software stack that they've created to kind of blur the lines between developer and operator to make it more to make the process of creating software more seamless. So I have a friend who works at Citibank, and I'll just give you an example of something that they do. So what JFrog, one of the products JFrog provides for Citibank is just scraping the internet of algorithms and data sets for whatever they're working on at a specific time, and organizing and analyzing them in a way that saves them hours and hours and hours to create whatever software packages they're creating at a given time. So in terms of how they grow, I just think they continue expanding like the companies that they're servicing and can continue expanding the product suite. But in terms of what I think of JFrog, it has been a really ugly company to own since it kind of peaked out about what $90 or $95. But I'm kind of just looking at that as long as the revenue growth stays in the mid 30s and their user retention stays very strong and their margin profile stays extremely promising. I do think in a few years this is going to be a free cash flow story that's still growing at 20-30% on the top line, and it's going to look really attractive. So today it's probably expensive. Today it is expensive, but I don't really invest for today or for next year. I'm kind of investing for several years from now, and I think if it just continues to do what it's doing in terms of creating a workflow that's easier for people like me who don't totally understand code, I think there's a lot of value in that.
Fantastic. Love that thought pattern. All right, I have a question for David. regarding SoFi versus Cash App. But before I get to that, real quick, a few people have been DMing me and asking if this is being recorded. And the answer is yes. So first off, Twitter actually records all Twitter Spaces for security reasons, but they don't give me that data, unfortunately. So instead, one of the Wolf Financial analysts, Josh Meltzer, who's in the call, if you can find him, I recommend giving him a follow because he's the one recording all these and taking notes and making it all nice for me to post the next day. So at Josh_Meltzer_, I might even make him a speaker at some point, but unfortunately, when I make him a speaker, it stops the screen record, is what we saw last time. So I'm going to wait till the end to do that. But Josh is recording right now. He's screen recording. So we're going to get that onto YouTube as fast as possible and onto my page for people to listen to. But all right, David, back to you. What are your thoughts on SoFi versus Cash App winning the all-in-one fintech battle?
Wow. Honestly, I don't know a whole lot about SoFi. I haven't really taken a deep dive into them, so I can't speak specifically. I think Chamath, obviously his cachet speaks for himself. I think he's been very successful. But yeah, I don't really know yet. I think that it seems like from the outside, SoFi probably has a leading in just actually banking products. But yeah, I don't know. I think you'll see Cash App maybe Square has a lead on more of the industrial space. But as far as like personal banking products, it's a really good question. I don't know. Maybe Brad has an opinion on it.
I do actually. I actually own SoFi. It's my only Chamath SPAC. And I don't want to get too into that, but I do love the management team and the Anthony Noto management team, not the SPAC management team. So that's why I own it. But in terms of who wins between Square and SoFi, I think they're both going to win. I think they're both going to do really well, and there's going to be a lot of fintech displacement in terms of the legacy financial system that finds a lot of success. But why I like SoFi is because they not only are kind of functioning as this consumer bank where they're letting you save, invest, spend, and collect interest on your money, but they're also powering services like Robinhood and Chime and Revolut and PaySafe through their Galileo APIs. So they are kind of the B2B and B2C duo in the fintech space, in that they have a successful platform that they're spending a lot of money on, and they're also powering the success of a Robinhood. So as other fintech startups succeed, and there will be many that will succeed, SoFi is also going to succeed with them, which is why I like that one. But I'm sure I don't know as much about Square as some of our other listeners, but I don't think one is going to succeed and that's going to mean the other doesn't succeed, personally.
Yeah, I think there's room for both in this area, like you said. Personally, I used SoFi for like a week just to try out the platform. It's interesting. There's a lot going on. When you work on these all-in-one apps, it's tough. I thought I would like the idea. I didn't end up liking it as much as I did. But again, I already had 3 other brokerages that I was using. So if I was someone who was just trying to open up my first brokerage and just trying to hit, I think an all-in-one platform hits really well for people who don't have a ton of stuff yet. Actually, it's a kind of a counterintuitive thinking. You'd think somebody who's all over the place, right? They would love an all-in-one. But I think that it's actually better for people that are just starting out. They get the all-in-one right off the bat. They're never branching out to all these other platforms. For me, it's tough. I use so many different types of platforms that it just doesn't seem reasonable for me. Okay, we got about 5 minutes left. Dylan, I appreciated your post and requesting to be a speaker. Talk.
I like to think to myself as somebody who's like just starting to figure out what they want from a all-in-one package. And I did use it, and I even got the debit card, and I even invested with it a little bit. I tried to start my own investing portfolio through that, and it does offer Bitcoin, which is pretty cool. And then once I started using SoFi, and I began moving my bank on over to SoFi and all, because I do have a 9-to-5 job on the side. And then I have, obviously I invest and I interact with the Twitter community. So SoFi is really great. They both offer fractional shares, but SoFi has a much broader share offering. So I did notice that on Cash App, it does not offer SPACs, or even like riskier stocks for that fact. But SoFi does, which is really interesting. And then SoFi also offers various different ETFs and a broader crypto offering too. So it does offer things like Bitcoin, Ethereum, and Litecoin, and et cetera, et cetera. And it also offers lending services too, as well as debit and credit cards. And they even offer interest on the cash that you hold in your bank account. So for me, SoFi, just from like a user, somebody who does like to have that online banking method, I mean, it's a blow-away winner. I think Moneyline is the only other one, and that's a Jonah favorite there. Moneyline is the only thing that I've seen that really even comes close to it in the first place. But SoFi, I mean, I'm IPOE long all day. You know, I'm a big fan of Chamath, and I'm a big fan of SoFi, and you know, it's a clear winner in my eyes. But when it comes down to the usability and just for somebody who wants to just dabble in this stuff, I think Cash App is going to be the clear